On the session today?
It was a pretty good session for the Australian market, especially given the leads going into the session. That is that we did see the US lower because of the good job numbers, and it looks like the US economy being able to support the normalisation of rates. So those good job numbers saw a sell-off in terms of the US equity markets. Secondly, those China trade numbers, they were absolutely dismal. But thirdly, just watching the banks, and the banks have had an enormous performance in 2015. In fact, Commonwealth Bank up 26% in the year to date so far, and while the market had a record-breaking 12 consecutive days of gains, that was driven mainly by the banks, which had 13 consecutive days of gains. Of course, the big one is going to be Commonwealth Bank with its half-year numbers out this week, but it does look like the income trade still continuing on. Of course, we're in the middle of earnings season as well, and there were some stellar results. In fact, we saw an all-time record high seen by both Ansell as well as Capilano Honey, both that came out with their results today, and we also saw a record high coming through from Certex. So while the market down just 0.1%, I think that was a pretty good result given the leads we saw this morning.
So do you think it bodes well for the rest of the week in terms of the market, Julia?
I think the rest of the week is going to be dependent on some of the big earning numbers, and the three that we're watching is Commonwealth Bank, Rio Tinto and Telstra. Now, Commonwealth Bank and Telstra are traditionally the dividends plays. With Commonwealth Bank, we are expecting to see a record interim numbers, but this is a stock that has rallied extremely hard, so it is priced for perfection, and unless we see a big jump in earnings and a big jump in the dividend, I guess the rally there may stall. Of course, Commonwealth Bank does go ex-dividend on the 17th of February, so they'll probably help to support the share price. With Telstra, we're looking for earnings growth, and where that earnings growth is going to come from in the future. We know that this is a stock with a high dividend yield. And then with Rio Tinto, this one should be an interesting one. This isn't traditionally what you would see as a dividend stock, but both BHP and Rio Tinto, it looks like will be handing out a lot more of their money in terms of a dividend. And of course, the massive franking credit balance is what investors are watching to see whether we are going to see a share buyback or some sort of structure which returns those franking credits to those Australian investors.
Scott Phillips, thoughts about a potential rotation, out of the well-done banks and in somewhere else?
I think the problem is the where to question. While interest rates around the globe are falling, all income stocks are looking overvalued, they're looking expensive, and they're basically moving along the lines of bond yields, which are pretty much near record lows. So when we have a look at countries around the world, yes, Australia is seeing a fall in interest rates, but we're also seeing negative interest rates in the likes of Switzerland and parts of Europe as well. So it does look like interest rates may keep on falling, and in the face of that type of environment, I think the yield trade is going to be one that's very popular and one that's still very overcrowded. The problem is that it's not earnings which are driving the share prices of these yield plays. It's the cut in interest rates that we're seeing in the global environment, where we are seeing very low interest rates and probably lower interest rates and quantitative easing to come. So while we see that, I think we're going to continue to see those income stocks well supported. The question is, where do you put the money, especially in the face of volatility in terms of commodity prices and what's happening globally? And I think that's the trouble that a lot of Australians face at the moment. There is a high danger because of the valuation, and traditionally high valuations equals lower future returns. But in the type of environment that we're in, I don't think it's earnings which are driving the share prices, especially when you see Commonwealth Bank up a massive 26% over 6 weeks. I mean, you could have said Commonwealth Bank was expensive 6 weeks ago, you'd be saying the same thing. But then again, people have been saying it for the last 5 years, and it's continued to rise.
So the question then, I suppose, Julia, Rick posed it, is do you think that interest rates are going to be low for the next couple of years? And I suppose if you're looking at the likes of Europe, Japan, and if you think they're going to have an impact on interest rates here, you'd have to say yes.
Well, it really does depend on global growth, and at the moment you have to say that it is looking pretty shaky. We have seen some softer numbers coming out of China. That's extremely important for Australia. But what's been holding up very well is the US market, and the question is, can you look at the US in isolation? Can it continue to power along while we see softness in terms of Europe and in terms of China, or are we going to see that global softness in terms of growth have an impact in the US? Now, the past few years we've seen the same type of arguments coming up again and again again, and we have seen that the world is interrelated. So it is going to be interesting, especially if the US does start raising interest rates, to see what it's going to have in terms of the impact on the economy over there. So I think it is interesting times. I think it is unusual times, and investors do have to be very cautious. Yes, this income trade is very popular, but as soon as interest rate expectations turn, I think that's when the danger zone really hits for income investors.
Let's move to some other